Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with BNZ. Today, the Reserve Bank has increased the official cash rate again by 0.25% to 3%. It's removing stimulus from the economy. Got to remember that the official cash rate has come down, as you can see here in this chart, from 8.25% down to 2.5%, a record low. And the Reserve Bank Governor has been saying that this is too much stimulus going into an economy that is recovering. Back on May 6, he described himself as a truck driver. I've got this handy cartoon here. A truck driver who was taking his foot off the accelerator as the economy went into the corner being higher inflationary pressures. But that was back on May the 6th. Since then, of course, he moved the official cash rate by 25 basis points from 2.5 to 2.75 on June the 10th. And since then, we've seen signs that the economy is softening, particularly in the domestic part of the economy, with retailing showing weakness, with the domestic economy, particularly around the housing market, also showing weakness. And today, the Reserve Bank Governor, while increasing the official cash rate, has come out and acknowledged that softness in the economy. He says commodity prices are weaker, house prices volumes are falling, and the retail sector is really struggling. So he's saying that the expected track for the official cash rate is likely to be lower and slower than what he previously forecast in June. Got to remember, back on June 10th in the monetary policy statement, the Reserve Bank forecast the official cash rate, well actually they forecast the 90-day bill rate, but that's a proxy for the official cash rate, that 90-day bill rate would rise towards 6% by the end of 2012. While the Reserve Bank Governor is now saying the extent and the speed of that rise in the official cash rate is likely to be more moderate than he forecast in June. So that suggests, and we don't know yet obviously, it's a long way away and things could change, but that the Reserve Bank's official cash rate, instead of going to 6%, as they were previously forecast, is more likely to go something to maybe 5%, maybe a bit higher than that. We're not sure, but it's clear that it's not going to be as high as it was. So what does this mean for people who are taking out mortgages or who are looking to invest in term deposits? Well, clearly, if you believed that the official cash rate was going to 6%, as the Reserve Bank previously forecast, you would have seen the floating mortgage rate around 9% by the end of 2012, early 2013. And now it's clear it's not going to rise so much. So perhaps we're looking at a 5% official cash rate and an 8% floating mortgage rate. That's the sort of thing you're looking at if we continue on this current track. And what about term deposit rates? Well, currently you're looking at a term deposit rate of around about 5.4% for the 18-month rate. Now that may increase in the coming year or so as banks look to compete hard for those term deposit rates and potentially put them up as interest rates rise and as competition around the world for savings continues to be intense. Remember, governments all around the world are raising money to pay for their deficits, and that's pushing up interest rates. So what does that mean overall for the economy? Well, obviously a rise in the official cash rate is going to subdue things even more, and it's clear that the first official cash rate change on June the 10th really did kick the economy in the guts, if you like, particularly the housing sector. And the signs that the Reserve Bank is going to keep increasing the official cash rate, although not as fast as before, may give some encouragement. So what does it mean for those people who are thinking, should I fix or should I float? Well, everyone's different, of course, and your appetite for uncertainty will depend and give you some idea on whether a fixed rate is better than a floating rate. In the past, it was always a clear winner to go for fixed because interest rates on fixed rates were usually cheaper, lower, than what you see for a floating rate. But in the last couple of years, last 18 months or so, that has been different, and floating rates have been cheaper than fixed rates, and that's still the case. The floating mortgage rate before today's official cash rate change was around 6%, and you'd expect that to increase in the next week or two to 6.25% for most floating mortgage rates. Now, the 2-year fixed rate is currently around about 7%. It's unlikely that will fall or rise, given we're seeing relatively weak wholesale markets and relatively low fixed mortgage rate bases, the swap rates as they call them. But it does make the fixed versus floating decision that little bit harder because those rates are a little bit closer together. Essentially, a decision about fixed versus floating is all about where you see interest rates going and where you see the economy going and where you see the global economy going. If you think we're in for a long period of deleveraging and grind and continual weakness in economic growth, then you'd expect interest rates to stay low, and therefore you're not going to see a big spike in floating mortgage rates all that quickly, and it would make sense to stay floating. But if you see interest rates really spurting much higher in the next year or two, as we see interest rates, inflation jump, the growth outlook surging ahead, inflation becoming a worry for all the central banks, then you'd have to think maybe a fixed rate is better. It all depends on your outlook for interest rates and your appetite for risk. Well, there we have it. The Reserve Bank has put up the official cash rate by 0.25% to 3%. That means floating mortgage rates are likely to rise to around about 6.25%. Term deposit rates stable to maybe slightly higher, particularly for those longer term rates. And we'll see the economy continue to struggle as interest rates rise. I'm Bernard Hickey. That was a special economic weather report brought to you in association with BNZ.